Welcome back to TMT. Today we learn about how you can make money trading. Now back in the 80s, the CME, the Chicago Mercantile Exchange, launched a futures contract that was linked to a specific stock index. That was the S&P 500 futures. The concept was simple. If the value of the S&P 500 went up, the price of the contract also went up. If the value of the S&P 500 fell, the price of the contract went down as well. You can imagine what a great concept that was. At that particular time, prices were going up across the board. Many corporations wanted to go long on many stocks, but did not have enough money to do so. Now they had the perfect solution. They could buy S&P 500 future contracts, and it was like trading all of the top 500 companies in the US at once. They did not need the same amount of money they would have needed had they traded all the stocks individually. They could do it at a fraction of the price and still make tons of money. At the end of the 90s, another S&P futures contract was created. It was an even smaller contract. The idea was to have small investors involved. That was the origin of E-mini, that we call ES. E stands for electronic and S for the S&P. Think about it. Now small investors like you and me could afford to trade all the top 500 companies at a fraction of the price. Individual traders wanted to have the same market opportunities, and the ES made it possible. So when you buy an ES contract, it is like buying shares in all of the top 500 companies at once. Now, let's explore better how we make money in the markets. In the market, there are two prices, the bid and the ask. The bid is the highest price that a trader is willing to pay for a contract at that particular moment. At the same time, the ask is the lowest price that a trader is willing to receive for a contract, again, at that particular moment. Now, the minimum price movement between the bid and the ask is known as a tick. We profit by earning ticks, and the profit for earning just one tick per contract varies according to the instrument you are trading. So here are some examples. If you are trading the ES, every tick equals $12.50. If you're trading the CL, crude oil, each tick is $10. The 6E, the euro dollar, each tick is $12.50. And the notes, the ZN, each tick is $15.62. Now, in order to trade one of these instruments, you will need a minimum trading margin. In simple words, margin is the minimum amount of money you must have in your account per contract in order to trade one of these instruments. Each broker will have different margins, but it will be around $400 to $500 for the ES, $500 for the 6E, $1,000 for CL, and $500 for the ZN. So say you want to take a trade with one contract in CL, in crude oil. You will need to have a minimum of $1,000 in your account. If you wanted to trade two contracts in the CL, then of course you're going to need to have a minimum of $2,000, and so on. Now, you make money every time you choose a particular direction to go, and the market then actually moves in that same direction. So if you're trading the ES and you decide to go long, every time the market moves up just one tick, you will make $12.50, then 2 ticks, $25, then 3 ticks, $37.50, and on and on. In this course, we will teach you simple strategies so you can be on the right side of the market. However, sometimes the market is going to go against you. In other words, it will move in the opposite direction. And that means that now, instead of profiting that amount for each tick, you will be losing that amount per tick. And if the market keeps going against you, then we keep losing ticks. So we have to protect ourselves when that happens. In order to do that, we use what is known as a protective stop or stop loss order that allows us to control our losses and manage our risk. We have spoken already in the last video about buy and sell orders. Now we've just mentioned a stop loss order. So let's talk about the different types of orders. For example, there is a limit order. Now this is an order that is placed to buy or sell at a specified price. That means that the order will only be filled when the market reaches that exact price. In the last video when I was showing you the dome, I was putting in limit orders, and I was filled at the exact price where I put my order. Next is the market order. This is an order that allows you to buy or sell at the best available price, whatever that price is at the moment that you put the order in. So again, in the last video, when you were watching me putting orders in on the dome, you saw me put them in at a particular price. Now sometimes I was filled immediately, and sometimes the order just sat there without being filled. And that meant that nobody was willing to buy or sell at that exact price at that moment. So I had to wait. Now, if instead I just put a market order, I would have been filled immediately at whatever price the market was trading at. Now, that might have been a tick or two away from the price that I ideally had wanted, because now that's exactly where someone is willing to buy or sell. The advantage with this type of order is that it guarantees an execution. It guarantees you're going to get into the market. On the other side, we often use market orders for our stops because it will guarantee getting us out of the market. So that brings us to the stop loss order. Now that's an order which is placed to buy or sell when the market reaches a particular point. And it's the type of order we use to limit our potential losses on a position. And now I'm going to show you how to set that up in a dome. Okay, so I decide that I want to buy at 37.60. So I'm going to put my buy order there. It's a limit order. It's a buy limit order. Because I want to get in at the price of 60, I don't want to get in at 61 or 62. If I just put in a market order at this point, it would fill me wherever the price was trading at. So it would take me in immediately at 61 or 62. However, I want the market to come to me. I don't want to chase after it. So I want to enter at 60, and that's the only price I want to enter at. Okay. So I have my order in, I've been filled. Now I need to place my stop loss. Now that's going to be a market order. And that means that as soon as price hits there, I am guaranteed it's going to get filled. Because I want to get out of that position if the market turns against me. Now to place a stop loss, you need to have a mouse with one of those little scrolly things in the middle. Something you can scroll down with, and that is actually a button. So to put a stop order, you have to put your mouse over the price in the dome where you want the order to be, and then you have to click the middle mouse button. Actually click on it, push down on it, and it will put the order in. If you don't set the order up that way, then it's just going to take it like a regular order and fill you. So it will either get you in the market selling instead of buying, or it's going to get you out of the trade simply at whatever the price is trading at. So you might actually lose money. So there, I've put in the stop limit order, and you place that on the same side as where your target is going to be. So in this case, I was buying the market, so I put both my target for where I want to sell on the sell side, as well as I put my stop loss on the sell side, so they both go on the same side. And I'm just going to try to get a tick here. So I'm going to put my target in there. And again, that's a limit order because I only want to sell when it gets to 61. If I had put it in as a market order, it could have gotten me right back out again at 60, which I wouldn't have had any profit. In fact, I would have lost a little money in commissions. And there we go. I'm waiting for my contract to be filled, and there it was. And I got my tick. And now I need to cancel my stop because that's an order, and if price comes down, it can fill me when I don't want to. If you had any kind of emergency, you could also hit the close button. Okay, now I want to show you another example of going the opposite way of taking a selling trade, just so you have it clear how it needs to look when you put your orders in. So I'm going to wait for an opportunity where I want to sell. Okay, so I think I'm going to sell here. I want to sell at 60. So again, I put in a limit order on the sell side. I want to sell it. That means that when there's enough contracts that want to buy at 60, then I can get in. And I went ahead and I put in where I want to put my stop loss on the buy side. And again, I did that by putting my mouse over the price where I want the stop loss to be and clicking the middle mouse button, the little wheel, the little scrolly thing. Now you can put a stop order in before your order's been filled if you want to. Of course, you can't put your target in until you've been filled. Okay, now I'm in the trade.
Order
and again,
filled.
I'm just going to put a one-tick target, so we go through this quickly.
Order pending.
Again, it's a limit order on the buy side. And up top I have my SLM, Stop Loss Market. It's a market order. And there we are, they're unfilled. And again, I need to go ahead and cancel out my stop. And that's what you have to do unless you have the possibility of doing an OCO. An OCO, one cancels the other. So how does that work? Suppose you buy a contract in CL when price is at $87 and you have the expectation to sell it at $97, and that would give you a 10-tick profit, which in the case of oil will mean $100 or $10 per tick. So now once your buy order is filled at 87, then you place a sell order at 97. And at the same time, you want to protect yourself and limit any possible losses should the market go against you. So you're going to place your stop order at 77. In other words, you are already in the trade, and now you have two pending orders. One to sell at 97 for a profit of $100, and another one to sell at 77 for a loss of $100. In case things go bad, in case things go against you. So at this moment, you have two active orders in the market. If you use an OCO, one cancels the other. Once one of the orders is executed, the other order is automatically canceled. Then you don't have to worry about canceling them out manually, as I just did. Okay, so next time on TMT, we're going to learn about trend, support, and resistance. See you then.